So for this week, we're going to cover Chapter 7, and specifically as we discuss the term called incremental analysis. So here are the various items that we're going to cover at some level. Understanding how managers make decisions in managerial accounting. And then we're going to talk about something called special orders. Special orders are utilized to keep the factory going. They don't always necessarily make a profit, but the goal is to utilize the equipment and the employees during a time when they may not have any activity. We're going to talk about making and buying decisions, and there are also products that they can process items further and potentially receive a better profit margin, or is it time to sell off those products and is the profit margin better? So we're going to talk about special orders and processing items further. And then when does a company replace equipment? When do you keep what you've got? And what are the factors in determining that? And then lastly, there are different segments of a business that may need to be terminated. How does a company decide which segments to terminate, whether to keep them? What are the various parameters in which they make those decisions? So those are some of the items we're going to talk about. This chapter is meaningful to me. It's got the meat, the meat of the crux of managerial accounting. So as we start here, decision making is what this is all about. This managerial accounting, the whole reason you're taking this course is to understand how managers use managerial accounting to help further and make decisions for the company. These decisions and the process in following the format in implementing and deciding decisions don't follow patterns. They vary, and the decisions are varying based on what the need is, but ultimately they're going to follow these steps. They're going to identify the problem, and they'll assign the responsibility of who needs to look into this problem. Then from there, as with every problem, you determine options, courses of action. From those various options or courses of action, then you make a decision. And then based on the decision you make, you're going to review the results after that decision has been implemented. So these steps usually are the same depending on what the issue is at hand. Business decisions involve financial information, and they also involve non-financial information. With financial information being about revenues and costs and profitability, where non-financial information may be related to turnover, the environment, and company's image. How many of you guys are familiar with Target? How many of you know anyone who works at Target? They've made some decisions in the past year that have affected actually a ton of my clients. People that were in the management sector of corporate many of them have been laid off. I can't believe how many have been laid off. Some of them are to decisions they made, a variety of decisions, but some have to do with them expanding into Canada. Their decision to expand into Canada flopped. And as a result of, hindsight's always 20/20, but as a result of expanding into Canada the manner in which they did, they have received a lot of backlash. And they definitely have had to make financial decisions in order just to cut the bleed. And yet some items, and the non-financial decisions, how that's going to affect morale at the company, the turnover, It's really not turnover as it is a lot more layoffs, and how it's ultimately affecting the company image. They have a new CEO now, so they're trying to sweep this under. Hopefully in a couple of years things are going to turn around. But it's a necessary evil, isn't it, whenever we're dealing with business decisions. So this is the process they utilize in order to make decisions, financial decisions and non-financial decisions. Now, this term we're using, incremental analysis, can also be called, as you see down here, differential analysis, because the analysis focuses on the differences between the various options or decisions, case A, B, or C, alternative actions. Process used to identify the financial data that can change under various alternative courses of action. It can vary by revenues and costs, or one or the other, by just revenues or by just costs. So here's an example how this works. In alternative A, you've got revenues of $125,000 and costs of $100. Alternative B has revenues of $110 and costs of $80. So you see, for the revenues, alternative A looks better. But when you're dealing with the costs, alternative B looks better. Ultimately, the net effect is a net income of $30,000 for alternative B versus $25,000 for alternative A. Does that make sense? So in looking at these various scenarios, the revenue, of course, is going to be less under B, but the cost savings of $20,000 is going to be greater for alternative B, and ultimately B is the way to go because it's going to provide a better revenue, net income. Important concepts, I want you to know these. The difference between relevant costs, opportunity costs, and sunk costs. Definitely different, and to understand these. Let's see here. We're going to go through. So, O&T Corporation is comparing two options. The company currently follows option 1 with revenues of $80,000 per year, maintenance expenses of $5,000 per year, and operating expenses of $38,000 per year. Option 2 provides revenues of $80,000, maintenance expenses of $12,000 per year, and operating expenses of $32,000 per year. Option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of $22,000. If option 2 is chosen, it will free up resources that will increase revenues by $3,000. So what we're going to do is create a table to look at the differences. So as you see here, option 1 is what they're currently doing. Option 2 is what they're looking into doing. So option 1 and 2, the revenues are the same. As it relates to maintenance expenses, with option 2, the maintenance expense would increase $7,000. However, with option 2, the operating expenses would decrease $6,000. But the $3,000, if option 2 is chosen, it will free up resources that will increase revenues by $3,000. So the opportunity cost is the cost that is incurred as a result of taking another option, of another choice. So option 1, because we know option 2 will free up resources in order to make an extra $3,000, option 1, we're going to show that as a cost of doing option 1, because we won't have freed resources to utilize option 2. So as you can see here, oh, and the other thing I wanted to show you is a sunk cost. A sunk cost is a cost that's already happened. You can't take it back. An opportunity cost is a cost potentially in the future of gaining some benefit by doing it another way. But a sunk cost has already happened and you can't recoup it. So the equipment upgrade happened 2 years ago. If they move and go to option 2, guess what? That equipment upgrade that they did 2 years ago, it's not going to help them anymore. It's sunk. It's already happened. You can't redo it. Sunk cost may be someone goes and decides they want to pursue a teaching degree, and the teaching degree costs them, they're in their 3rd year, costs them $70,000 to do. And in the 4th year, they decide, I don't want to teach anymore. Okay? Now, some of those courses might count, but a lot of the education courses may not transfer. Those are sunk costs. It's not going to change what you've already done. Does that make sense?
In actual practice of this, I know this is entirely theoretical, but would the equipment upgrade be actually the net of what's already been amortized, assuming you used it for 2 years?
And what you're saying, guys, the bummer with this, so as far as we're dealing with the equipment upgrades, by switching to option 2, we no longer need that equipment. That's why that is a sunk cost. It's already happened. We can't do anything about it. That type of cost is called a sunk cost. Now, accepting orders at a special price. Obtaining additional business by making a major price concession to a specific customer. This assumes that the sales of products in other markets are not affected by the order and assumes that the company is not operating at full capacity. So oftentimes plants will accept special orders just to utilize the factory. They might not make much money on the deal, but when you look at the picture as a whole, utilizing their employees, running the equipment, it may be to their benefit to accept special orders than to have an idle factory. Make sense? Here's an example of this. Sunbelt Company produces 100,000 smoothie blenders per month, which is 80% of plant capacity. Variable manufacturing costs are $8 per unit. Fixed manufacturing costs are $400,000 or $4 per unit. The blenders are normally sold directly to retailers for $20 each. Sunbelt has an offer from Kensington Company, a foreign wholesaler, to purchase an additional 2,000 blenders at $11 per unit. Acceptance of this offer would not affect normal sales of the product, and the additional units can be manufactured without increasing plant capacity. What should management do? Well, guys, the fixed manufacturing costs happen anyway, don't they? So really, in making this decision, aren't they really focusing more on the variable costs? Does that make sense? So in this respect, if they reject the order, they don't make any extra money. Their costs, if they reject the order, don't affect anything. If they accept the order, it's just the variable cost. So the net income is an increase of $6,000. Sure, they're not making what they do normally make, but overall, in accepting that order, aren't they still better off? Assuming they have the means, they're not having to go out and buy more space. They have the means in order to do it. Fixed costs don't change, since within existing capacity, they're not going to be relevant. Relevant costs are those costs that matter in making decisions. So we've talked about sunk costs or costs that have already incurred, that are a done deal. Opportunity costs are going to be costs you miss, or opportunities you miss by not taking the other option. And relevant costs are those costs that are affected and matter in making decisions. Variable manufacturing costs and expected revenue changes are relevant to this decision. Let's look at this one. Cobb Company incurs costs of $28 per unit, which are $18 variable and $10 fixed, to make a product that normally sells for $42. A foreign wholesaler offers to buy 5,000 units at $25 each. Cobb will incur additional shipping cost of $1 a unit. Compute the increase or decrease in net income Cobb will realize by accepting the special order, assuming Cobb has excess operating capacity. Excess operating capacity means it's not going to hurt them to do this job. Should Cobb Company accept the order? So the revenues, if they don't accept it, aren't going to change. But if they accept it, it's going to make a difference of $125,000. The costs are going to be the variable cost plus the shipping, right? But ultimately, what's their revenue going to be? $30,000 in order to do it. So it's probably going to be something that they will accept. Okay, now, actually, let's take a moment and look at a problem in the book that goes over something similar to this. So if we go to chapter 7, okay, let's look at exercise E2. Gruden Company produces golf discs, which it normally sells to retailers for $7 each. The cost of manufacturing 20,000 golf discs, materials of $10,000, labor of $30,000, variable overhead of $20,000, fixed overhead of $40,000. Gruden also incurs 5% sales commission, or 35 cents on each disc sold. McGee Corporation offers Gruden $4.80 per disc for 5,000 discs. McGee would sell the discs under its own brand name in foreign markets not yet served by Gruden. If Gruden accepts the offer, its fixed overhead will increase from $40,000 to $46,000 due to the purchase of a new imprinting machine. No sales commission will result from the special order. Prepare an incremental analysis for this order. Should Gruden accept it? And what assumptions underlie this decision? So if we go here to E2, I don't think I have E2 on here. So if we go here to E2, let's create an example, okay? So let's show if, just like we were doing in the previous ones, if we reject the order or if we accept the order, and the difference. Okay? So the revenues in this decision were at how much did it tell us? The revenues, McGee Corporation offers Gruden $4.80 per disc for 5,000 discs, okay? So the revenues are going to be $4.80 for disc for $5,000 discs. $4.80 at 5,000. So what would that be? 4,080 times 5, 24,000, okay? So the difference is going to be difference, and decrease is going to be in a negative. Okay, so this is an increase of 24,000. Okay, what are our materials? If we go back here, it shows the McGee would sell the disc under its own brand name. If Gruden accepts the offer, its fixed overhead will increase from 40 to 46 due to the purchase of the new imprinting machine. But materials generally are $10,000 for 20,000 discs. So $10,000 for 20,000 discs are 50 cents a disc, right? Per disc. So 50 cents times, we're going to do 5,000 discs. Wouldn't that be $2,500? Right? Yes? No? Okay. And then what about our labor? If we go and look at our labor, our labor is $30,000 for 20,000 discs. What's that going to amount to per disc, guys? About 50? So labor is $1.50 per disc. So $1.50 times 5,000 discs, 7,500. Then we've got the next one, variable overhead. Our variable overhead, if we look at this, $20,000 for 20,000 discs. A buck, right? A buck per disc. That would be 5,000 bucks, wouldn't it? Then we've got fixed overhead. What is our fixed overhead? It's not going to change based on doing nothing, but our fixed overhead, we're going to add how much more? $6,000, right? Then our sales commission. Are we going to have to pay sales commissions? No. So that is not going to be a factor here. So if our net income is going to be $3,000, right? What do you guys think? Should he accept the order? If we're just dealing with money, it would say yes, accept the order. Now, the next question asks us here, what assumptions underlie the decision made in Part 1? Well, one thing that it does tell us, the decision made in Part 1 does say, exercise 2, it is assumed that sales of the golf discs in other markets would not be affected by the special order. If other sales were affected, Gruden would have to consider the lost sales in making this decision. Second, if Gruden is operating at full capacity, it's likely that the special order would be rejected. So, if in fact by making these decisions it could flood the market, they probably wouldn't want to do that, would they? Because it would have an impact on their other sales. Make sense? Any questions on that before we move on? Is that helpful? Okay, so let's look now at what we call the make or buy decision. Do we make something, or is it more economical to just go out and buy it? Right? Bear & Company incurs the following annual costs in producing 25,000 ignition switches for motor scooters. Direct materials, 50,000. Direct labor, 75,000. Variable manufacturing overhead, 40,000. Fixed overhead, 60,000. For total manufacturing cost of 225,000. The total cost per unit, 225,000. Divide that by 25,000 ignition switches is $9. Instead of making its own switches, Bear & Company might purchase the ignition switches at a price of $8 per unit. What should management do? So, chances are it's better for them to go out and purchase the ignition switches if all other issues remain the same. My husband does this to me a lot when I was getting into making cards. Have you guys ever heard of like making greeting cards and you buy all your paper and the different things? Well, he determined that every card I made ended up costing us about $50. So his attitude is, just go buy it. But he wasn't taking into account something very important. Thank you. My enjoyment. And that heartfelt just love that was expressed in that card because I was making it, right? I know. I tried to tell him that, and he's too much into manufacturing. I know. So, make or buy decision. So we know in this case, we have if we make it, the various costs. Now let's look, if we take into account potentially the direct labor, let's just see what happens here. What would happen here, the direct materials, we're not going to have to fork out if we buy it. Our direct labor, they're saying we're not going to have to utilize. Our variable manufacturing costs we're not going to have to utilize, but our fixed we're going to have anyway, aren't we? And we're not going to purchase price of $8 versus the fixed. In this case, to buy it, if we take into account our fixed manufacturing costs, because we've paid for them anyway, they're going to go unused. So even though it cost an extra buck, or it's an extra buck less for us to go out and buy it, because fixed manufacturing costs in this situation would be relevant, it is advantageous for us to make it than for us to buy it, because we have to take into account those fixed costs that we have no matter what. Okay? Opportunity cost is the potential benefit that could be obtained from following an alternative course of action. In the make or buy decision, it's important for management to take into account the social impact on its choice. For instance, buying may be the most economically feasible solution, but if an action would result in the closure of a manufacturing plant that employs a lot of workers, maybe they will choose to continue to make it just because of how it will affect the environment, the economy, the community. Let's look at what we're going to term opportunity cost. Assume that through buying the switches, Bear & Company can use the released productive capacity to generate additional income of $38,000 from producing a different product. This lost income is an additional cost of continuing to make the switches in the make or buy decision. So now that we know we could free up resources that would allow us to make something else, it does now become an opportunity cost. Okay? So in this scenario, if we make them, it's going to cost us $225,000. The opportunity cost in continuing with this course of action and not doing the other one is basically we're going to lose $38,000 of other revenues, which means our total cost in making it now is $263,000. But in buying it, it's going to cost us still $250,000. Remember, because of the fixed cost and what it cost us. So now when we add something else into the equation, do you see how then potentially the decision will change? In a make or buy decision, relevant costs are manufacturing costs that will be saved, the purchase price of the units, opportunity costs, or all of the above. All of the above. Okay, let's look at this example, then we'll go back to the book and do one, okay? Juanita Company must decide whether to make or buy some of its components for the appliances it produces. The cost of producing 166,000 electrical cords for its appliances are as follows. Direct materials are $90,000. Direct labor, $20,000. Variable overhead, $32,000. And fixed overhead is $24,000. Instead of making the electrical cords at an average cost per unit of $1, the company has an opportunity to buy the cords at 90 cents a piece. If the company purchases the cords, all variable costs and 1/4 of the fixed costs will be eliminated. Prepare an incremental analysis showing whether the company should make or buy the electrical cords. Will your answer be different if the released productive capacity will generate additional income of $5,000? Okay? So in this scenario, if we make them, we're going to determine it's $1 a piece. If we buy them, it's 90 cents. But in addition to that, if the company purchases the cords, all variable costs and 1/4 of the fixed costs are eliminated. So these fixed costs, 6,000 of those costs get eliminated. Okay? So if we make them, we know 166,000. If we buy, 1/4 will be eliminated, which means it's still going to cost us 18,000. I'm sorry, guys. And this is going to be the price to buy, the 166,000 at 90 cents. So look here, for us to make them, it still is cheaper than for us to buy them when we take into account the fixed costs. So in this scenario, we're better off to make them. Now, if we take it that next step further, the opportunity cost, remember that we're going to lose by making them? In this case, chances are now we would buy them. Okay? Because we're adding something else into the mix of our decision to make. Let's take a minute and let's go back and look at a problem related to this. Okay? Okay, E76. Oh, I don't have that in here. Okay, so E76 basically says, Jobs, Inc. has recently started the manufacture of Tri-Robo, a three-wheeled robot that can scan a home for fires and gas leaks and then transmit this information to a smartphone. The cost structure to manufacture 20,000 Tri-Robos is as follows. Direct materials, $50 per robot. Direct labor, $40. Variable overhead, $6. Allocated fixed overhead, $30. For a total of $2,520,000. Jobs is approached by Tin Inc., which offers to make Tri-Robo for $115 per unit, or $2,300,000. Using incremental analysis, determine whether Jobs should accept this offer under each of the following independent assumptions. So, number one, assume that $405,000 of the fixed overhead costs can be avoided. So should we make them or should we buy them? Okay? So let's go in here. What number was this? 76? Okay, so we've got here make, buy, net increase or decrease, okay? So the first one, direct materials. To make it, 1 million, right? To buy, we've got nothing. What's next? Direct labor. To make it, 800,000. To buy, 0. Okay, next, variable overhead, 120, right? Nothing here. Next, fixed overhead. To make it, 600,000. But what did it say here, guys? If we buy it, we can eliminate 405,000 of the overhead costs, right? So how much are we able to eliminate? The 600 minus the 405 we can eliminate means what is a relevant decision or a relevant factor in the buy piece. 600 minus the 405 gives us how much adds to our cost. 195. Okay? right? Okay. Then purchase price doesn't matter. 0 either on the buy, it's going to cost us $2,300,000 to purchase it. What do you think they're going to do, guys, on this scenario? Make or buy? They would want to buy it under that scenario, right? Okay, now let's look at the next. Do you guys want me to sit on this a minute? Okay. Then let's look at the next scenario. Assume that none of the fixed overhead costs can be avoided. However, if the robots are purchased from 10 Inc., jobs can use the released productive resources to generate additional income of $375,000. So what's going to happen here is the fixed overhead, none of it can be avoided, right? And now we've got an opportunity cost here, don't we? That we will lose if we make it versus buy it, right? Does that make sense what I'm doing? So if we make it, then we're losing out $375,000 on something else we can do. And in this scenario, none of our fixed overhead are avoided. So we have to add in all of it. So in this scenario, what is a better option? What? Still cheaper to make it. Exactly. Now it asks us, describe the qualitative factors that might affect the decision to purchase the robots from outside suppliers. What would be qualitative factors? Well, I'll help you with that. Qualitative factors include the possibility of laying off those employees that produce the robot and the resulting poor morale of the remaining employees, maintaining quality standards, and controlling the purchase price in the future. Okay? Now, I'd like to tell you that companies make decisions based on those qualitative factors. I have seen so many times when those qualitative factors really aren't a piece. Northwest Airlines years ago broke the mechanics union. And any of you guys remember this? Back in 2005, the mechanics were going to go on strike, and the company called its bluff and laid them off. Now, they had ahead of time prepared for outsourcing a lot of this work. And it was in many ways a pure economic decision they did in breaking the union. The energy and effort, sometimes a lot of people said it ended up costing so much more money for them to bring in all of these emergency mechanics and prepare for it than it did in just letting them all leave. It would have been cheaper just to have given them what they wanted, but their decisions were more long-term. And today, now that Delta has them, you would hear a lot of them say the environment is so much better that there's not a union there now. Again, I'm not trying to advocate for or against unions. It's just that the whole process that occurred and Delta's management came in, the climate's way better. A lot of them just ended up getting huge bonuses because of profit sharing. So it's not one right or wrong answer. It's all going to fluctuate based on who the people are that are making these decisions. Okay, guys, any questions on this so far? Anything? You want me to do another one of these make or buy? Okay, yes. I hear someone say yes. Riggs Company purchases, sales, and produces sailboats. It currently produces 1,200 sailboats per year, operating at normal capacity, which is about 80% of full capacity. Riggs purchases sails at $250 each, but the company is considering using the excess capacity to manufacture the sails instead. The manufacturing cost per sail would be $100 for direct materials, $80 for direct labor, and $90 for overhead. The $90 overhead is based on $78,000 of annual fixed overhead that is allocated using normal capacity. The president of Riggs has come to you for advice. It would cost me $270 to make the sails, she says, but only $250 to buy them. Should I continue buying them or have I missed something? So we're going to prepare an analysis and decide first if the sails should be made or bought. So, am I doing 7-7? So I don't have one here for 7-7. Okay, so let's look here. 7-7. We've got here so as far as this is make sales or buy sales, okay? And the net income from doing it. So what would be the direct materials? To make sales is $100, right? To buy sales is $0. Okay? So this is actually net increase. Then direct labor, 80 versus buying sales is nothing. The variable overhead is how much per sale? $90 is based on $78,000 of annual fixed overhead that is allocated using normal capacity. $90 times 1,200. Okay. 1,200 sailboats per year. Yeah, and what would that be? Let me just look at it. What is $90? 78,000. What is 90 times 1,200? 108 minus this. Okay. My mind is not. Okay, let's look here. So to make them, the $90 $90. So 78,000 divided by 1,200 is what? 78,000. Yep. Divided by 1,200 equals 78,000 divided by 1,200 is 65. So basically, let's look at it that way. So the fixed cost of 78,000, if we divide that by 1,200, we get $65. Okay? They are allocating $90 overhead. Okay? So the $90 includes $65 of fixed costs. So the difference is $25. Does that make sense? The purchase price isn't going to matter. That doesn't matter on that one, but on this one it costs $250 per. In this example, what they're trying to have us do is compare if we make them. We're going to still have the direct overhead. But the way this was worded, this isn't a great question. The way this was worded is they want us to pull out the variable piece here. Okay? So in this scenario, I do agree with you because all the other problems we did took that into account. But this specific example isn't asking us to do that. Okay? So that's where it's not getting that detailed yet. Okay? It's just telling us, let's take and do what the materials, labor, and variable overhead is. Figure that out. And you're exactly right. It's not taking that into account, but it's not asking us to. Okay? And then let's take what it's going to cost us to buy them. And what it's showing here is just pure variable costs. To make it is $205, to buy it is $250, which means it's still more expensive to buy right here than it is to make. Okay? So basically, they're going to benefit $45 per sale to make it. Now, if, like you said, if you take into account, and think about it, guys, it is still important to just make it, because in buying it, technically, we're not even taking into account these fixed costs. So if these are just the variable costs, taking variable cost against making it, it still is better for us to make it. Okay? Because think about it, the fixed cost in this scenario, they're not asking us to make that decision, but those fixed costs we're going to have anyway. So if it came out and said, oh, we need to buy them, well, technically those fixed costs are going to happen anyway. Let's move on, and it says here, B. If Riggs suddenly finds an opportunity to rent out the unused capacity of its factory for $77,000 per year, would your answer change? You think? So in this scenario, instead of make, we've got this ability to add $77,000 per year, or on 1,200 units, 77,000 minus what it would cost us to buy it of 54,000. In that difference, then if we're going to get that extra money of 77 versus this 250 to buy it times 1,200 units, 250 times 1,200 units is 300. No, I've got to take into account the fixed cost. Those fixed costs were 65 per unit. So the fixed cost of 65 per unit times 1,200 units of 78,000 versus well, they're not taking that into account. This isn't a great problem. Let's go and show this. For this scenario, the manufacturing costs would be, in this scenario, if we are going to rent it or not, if we make the sales, the manufacturing costs in making the sales are, let me just call this manufacturing costs. To make the sales would be $246,000, and then what we would call our opportunity cost, because we could lease it out, of $77,000 would be making the sales. Ultimately, our cost in here are $323,000. To buy the sales, we would have to pay how much to buy the sales? $300,000. Purchase. So if we took this into account, they're telling us, again, we're not taking into account fixed costs. They would say it's better for us to buy the sales in this scenario. When you do these problems, I will make it really spelled out like we had in the PowerPoint, which factors to take into account. Okay?
I don't understand though. So her question would be like, all the math aside, you have an opportunity to rent out an unused capacity of your factory for virtually any dollar amount that's going to be beneficial to your business, right? It's an unused capacity. So
In this example, though, they were going to use that unused capacity to make
The sales.
oh, okay. I missed that. Okay, gotcha.
So that's why it becomes a relevant
Okay,
item.
that's great.
Okay. Let's do one more. Let's do 7-8, okay, guys? Innova uses 1,000 units of the component IMC2 every month to manufacture one of its products. The unit costs incurred to manufacture the component are as follows. Our direct material, our direct labor, and our overhead give us a total of $236.50. Overhead costs include variable material handling costs of $650, which are applied to products on the basis of direct material costs. The remainder of the overhead costs are applied on the basis of direct labor dollars and consist of 60% variable cost and 40% fixed cost. A vendor's offered to supply the IMC2 component at a price of $200 a unit. Should Innova purchase the component from the outside vendor if Innova's capacity remains idle? So, what we're going to do here, we'll have this information here. We've got our direct materials, our direct labor, and our overhead. And then it gives us the overhead includes some variable material costs of $650. So, if we make it, our direct materials are, excuse me, $65, okay? Right? If we buy it, again, nothing. Then our direct labor, $45. The material handling, $6.50, right? The variable overhead is 60% 60% of variable cost and 40% of fixed cost. So 60% of $126.50 minus that $650. Okay? See what we're doing there? Taking the overhead costs, subtracting out the $650, and only taking 60% of those, which is $72. Okay? And to purchase it is $200. Right? So in this scenario, is it better for us to make it or to buy it? Make it. So it shouldn't be purchased because it's going to be $11.50 greater than if it was made. Now, the next part of this question says, should Inova purchase the component from the outside vendor if it can use its facility to manufacture another product? What information would Inova need to make this decision? So if we're purchasing 1,000 units at $11.50, then we would need to be able to bring in more than that in order for us to choose to manufacture it. Okay, guys, let's go back now to the next one. Do we sell an item or do we process it further? So we may have the option to sell a product at a given point in production or to process it further. We process it further as long as the incremental revenue from the processing exceeds the processing costs. So as we see here, Woodmasters makes tables. The cost to manufacture an unfinished table is $35. The selling price per unfinished unit is $50. Woodmasters has unused capacity that can be used to finish the tables and sell them for $60 per unit. For a finished table, direct materials will increase $2 and direct labor costs will increase $4. Variable manufacturing overhead costs will increase by $240 or 60% of labor. No increase is anticipated in fixed manufacturing cost. So we've got our materials, our labor, our variable, and our fixed for a total manufacturing cost of $35. So the incremental analysis is to take what we sell it for unfinished of $50, our cost per unit, materials, labor, and overhead, and our fixed manufacturing gives us a net income per unit of $15. But if we process it further, we get to sell it for $60. But we are going to have additional materials, additional labor, and additional variable overhead. So if in fact we process it further, instead of bringing in a net income per unit selling it unfinished of 15, we can process it further and our net income is $16.60. So if you look at it this way, should they sell it or should they process it further? In this, if just we're dealing with money, we would process it further. So we've got a scenario where oftentimes, like oil companies, we have one product that is like a batch processing, and we can make various items from it. Joint product situation for the creamery. Cream and skim milk are products that result from processing the milk. Joint product costs are sunk costs and thus not relevant to the sell or process further decision, because the joint product costs have already happened. They're going to already occur. Here's an example for a multiple product case where for cream we have joint cost to allocate cream of $9,000, and then the cost to process cream into cottage cheese is $10,000. Revenues per day of cream is $19,000 and of cottage cheese is $27,000. The question is, should we just sell cream or should we also process it to make cottage cheese? Okay? So, just by selling cream, we have sales of $19,000. But if we sell cottage cheese, our sales increase to $27,000, but we also have an extra $10,000 in costs to get there. So in this case, we kind of just want to sell the cream, don't we? We don't want to process it further into cottage cheese. Here's another one. We can allocate it to our allocations to skim milk and to condensed milk, 5 and 8. Revenues from skim milk are 11, but then condensed milk is 26. So if we show just our skim milk, we've got 11. If we process it further into condensed, you can tell here in this scenario, we're better off processing it into condensed milk.
Why do you not look at the costs for skim milk?
Because what we're doing is just trying to see, sorry guys, how do I bring it back here? In this scenario, what we're trying to do is we're comparing the 11. That's our raw number, 11,000. And then if we want to process it further, we have to take into account the difference between the extra revenues and the extra costs. We can't just take into account the extra revenues. We're just using that skim milk piece as a starting point, and then from there determining if it's to our benefit to process it further. So we're just looking at sales per day. Now remember, this is a given, just the sales. To add, the question is, do we just keep it as is or do we process it further? So any cost used to process the skim milk really isn't relevant in our decision to process it further. Yes. Okay. Let's look at this one. To sell or to process it further. Easy Does It manufactures unpainted furniture for the do-it-yourself market. It currently sells a child's rocking chair for $25. Production costs are $12 for variable and $8 for fixed. Easy Does It considers considering painting the rocking chair and selling it for $35. Variable costs to paint each chair are expected to be $9, and fixed costs are expected to be $2. Prepare an analysis showing whether Easy Does It should do it. Well, to sell it is just $25. To process it further is $35. So in this scenario, the net income is $5 for just the unfinished chair. But if we have to process it further, it's not worth it to us, right? We get more revenue, but our costs are greater than our revenue. Actually, our costs in processing it further, we've got $1 extra in revenues. Bottom line, we want to sell it unfinished.
Why would we look
Correct. They were already taken out, and we were just looking at the additional. And they were just showing us that added piece of costs. Jeffco Company is considering replacing a factory machine with a new machine. Jeffco Company is a factory machine that originally cost $110,000. It has a balance in accumulated depreciation of $70,000, so the book value is $40,000, which has a remaining life of 4 years. The company is considering replacing this machine with a new one. The new machines available that cost $120,000, which is expected to have zero salvage value at the end of the year. If the new machine is acquired, variable manufacturing costs are expected to decrease from $160,000 to $125,000, and we know we can sell that old unit with a book value of $40,000 for $25,000. Oh, excuse me, sell it for $5,000. So this incremental analysis will show to retain the equipment, we'll have variable costs, equipment costs of $640,000. To replace the equipment, we're going to have $615,000 in costs. So ultimately, it's showing here, we're ultimately better off in this scenario with these relevant costs to replace the equipment. Make sense? Retain, repair, or replace. What matters, the book value, does not affect this decision because it's a sunk cost. It's already occurred. It's the way it is. We can't go back and change it. The costs which cannot be changed by future decisions are not relevant in our incremental analysis. But trading in or disposing of it is relevant. So the $5,000 we're going to get from that machine is relevant. Okay? So here we've got an example. Rochester Roofing is faced with a decision. The company relies heavily on the use of its 60-foot extension lift for work on large homes and commercial properties. Last year, the company spent $60,000 refurbishing the lift. It has just determined that another $40,000 of repair work is required. Alternatively, Rochester Roofing has found a newer used lift that's for sale for $170,000. The company estimates that both the old and new lifts would have a useful life of 6 years. However, the lift is more efficient and thus would reduce operating expenses by about $20,000 per year. The company could also rent out the new lift for about $2,000 per year. The old lift is not suitable for rental. The old lift could currently be sold for $25,000 if the new lift is purchased. So we're going to create an incremental analysis with a lot of information on here. So if we retain the equipment over 6 years, we've got operating expenses of $120,000, repair cost of $40,000. Replacing the equipment, we'll have rental revenue of $12,000, paying for the new equipment, and selling the old one. So in this scenario, it looks like based on a 6-year period, they recommend replacing the equipment. Okay? Let's take a minute break here and I can get this uploaded. Let me turn off my